moderate investors' asset allocation for both 2010 and with its predecessors for the period since 2000. For the previous 10 years, its predecessors were up about a cumulative 104%. Let me translate this all for you. And he quotes, I want you to invest 5% in cash and the rest in 10 different funds about which you know absolutely nothing. I want you to make this investment knowing that even if there were 128 hours in a day and you had a year-long vacation, you cannot possibly begin to understand all of these products. In fact, I don't understand them either, but because I know it sounds good and everyone is making the same kind of recommendations, we can all pretend that we're smart and going to make a lot of money until we don't. Asset allocation is about making you a sucker. Do you seriously want to put a significant percentage of the money you will need for your future in funds that put your money into things that you have absolutely no idea about? Will you have any clue when to change your asset allocation? Will you change it based on changes in the dollar, changes in domestic inflation, changes in European inflation, inflation in China, changes in tax laws in Italy and Greece, changes in interest rate, trade balances? It comes down to this, folks. Do you want to invest in something you know or in something Wall Street wants you to believe? Do you really think your broker, his boss, and the analysts at their firm really are being completely honest with you about how much they know about these investments and they want you to make? Ask them if they're making the exact same investment with their money. Ask them if they would make the same investment if they were not allowed to look at a quote screen all day long like you aren't able to, which tells you if they trust the investment or want to watch it second by second, knowing they may have to pull the trigger and get out at a moment's notice. Ask your broker for the names of the people they get a call from and let them know that their investments have been wiped out. Talk to those people to understand what the ramifications of making an investment in something you know nothing about might be. Don't be a sucker. Remember this, it's better to make less or next to nothing than to lose everything. Don't get greedy. Don't get desperate. The stock market can't save your financial future, but it can end it. I just thought that was a great article. I really think a lot of it, and I want to share it with you once again. Mark Cuban, a great entrepreneur. Well, we're up against a break, so don't go away. If you'd like to give me a call, it's 296-4464. That's 296-4464.
More financial strategies.
If you've missed any portion of today's show or you'd like to hear it again, simply go to www.790knst.com. Click on the On Demand tab and in the drop-down menu, select Podcasts to go to this weekend's show or Safe Money Strategies. You can also always listen to the show streaming live at 790knst.com. Thanks for listening. This is Safe Money Strategies.
More financial strategies.
Okay, we're back for a last segment, and folks, I ran over on the others, but I did want to spend this time explaining to you how annuities work. You know, like Mark Cuban said, you need to understand what you're dealing with. First of all, it's insurance. When you're in the market, you take the risk. When you're in insurance, the insurance company takes the risk. So that's the first and most important thing. You know, for so many Americans, retirement is a time to look forward and anticipate a better time. You know, more leisure, hobbies, grandkids, travel, planting the flowers, whatever. You want to make sure that you have an amount of income that you can never outlive. It's one of the most important things that you have to deal with, and certainly the number one concern I hear from folks coming in. A key risk that faces you is longevity. That's outliving your retirement savings. For a couple age 65, there's a 50% chance one spouse will live to age 92 and a 25% chance that one will live to age 97. The most important feature of our fixed indexed annuities is protection of your purchase payments and previously credited interest against market downturns, as well as the ability to add a rider to guarantee income for life. Most products offer this income rider. When you purchase the income rider, you're giving yourself security, and you're also guaranteeing that if you only withdraw a set amount each year, called the lifetime annual income, it will be available to you for the rest of your life and your spouse's life if you take a joint payout. And you can do that with an IRA or a 401k. You can set up the payout for joint. That gives a lot of security to the spouse that doesn't have the big 401k. When you're in the market, your broker may suggest that you take out 4% or even 3% per year. But where's the assurance that you won't lose 20 or 30 or even 50% of your nest egg in the next downturn? Then what do? You have no assurance that your money will last for the rest of your life. Let me explain how income riders work in general. First of all, there is no charge for the annuity and no charge for me. I do not charge fees. The income riders do have a fee ranging from 0.60% to 0.95%. Both of those are under 1%, and that's the only fee. The fees guarantee the roll-up, or the percentage of annual growth, and the lifetime income. The income benefit base is used to compute the lifetime annual income and the cost of the rider. The income benefit base is equal to your purchase payments, the money you put in, plus the bonus on the purchase payment in the first year. In most of these products, you get a bonus added right to what you have, plus you get a stacking roll-up. This is not the cash value of your policy. It can't be accessed. It's not an amount that is available for withdrawal or for a death benefit. It's just there to show you how your money is growing. The stacking roll-up increases the income benefit base. It's calculated by adding together the weighted interest applied to your account value with the guaranteed growth of 4 to 7% depending on the product. The roll-up term begins on the contract date and ends on the day you start taking income. Some companies will allow you to grow your income benefit base for up to 20 years. Obviously, the longer you wait, the higher your income payout is for life. I like to tell folks that it's like looking at your Social Security statement. It tells you how much you will have if you take it out at 62 or 66 or 70. Once you decide to take it out, that's it. You get a schedule of guaranteed growth and the percentage of the income account value that you'll be able to take at any given age or year. So you decide how much income you want to have. The annuity and the rider are two separate entities. If you don't want the lifetime income and you just want a place to park money, either IRA or after-tax funds, you can put it into an annuity with no charge at all. With most annuities, you can withdraw up to 10% penalty-free per year after the first year. So you do have flexibility on withdrawals. You can use 401ks, IRAs, and other qualified plans to roll into these annuities. Non-qualified funds or after-tax money may also be rolled into these annuities, and there are no tax consequences provided that it's handled properly. On the contrary, there are great tax advantages for your non-qualified after-tax funds that may be in mutual funds, stocks, bonds, money markets, or CDs. Now you're receiving 1099s each year for the earnings on these funds, even if you didn't take them out. And you're paying many fees and charges for them. By moving to an annuity, you grow your money tax deferred, thereby having the advantage of triple compounding because you're earning interest on your principal, interest on your interest, and interest on the money that you would have paid for taxes. Doesn't it just make sense to explore if this is the right thing for you? I'll give you a quick example. Here's a client that came in who was 59 years old. He had a little over $500,000 in his 401k. With this particular product, he was going to get a 12% bonus. He would get 6% the first year and then 2% a year for the next 3 years on the accumulated value. So at age 65, when he retires, because he's still working, and by the way, If you're 59 and a half, you can roll out your 401k from work into your own annuity with me. But he was still planning on working till 65. At 65, he would get a payout of $39,443 a year, guaranteed for the rest of his life. That's $3,287 a month, coupled with his Social Security of $2,800 a month and some of his other savings. He can look forward to retirement with peace of mind. That's what I'd like to do for you, but as usual, this time just flies by and I'm at the end of another show. Give me a call, folks, at 296-4464. You won't be disappointed. I promise you come in and see me. You'll walk out the door knowing a lot more than you knew when you walked in. I don't pressure anybody. My clients can tell you that. I just like to help people understand their options. You can also go to my website, www.morefs.com. That's morefs.com. In the meantime, until next week, as always, folks, stay safe, stay happy. God bless you. Have a wonderful weekend.
You've been listening to Safe Money Strategies with Susan Moore-Vault, president of Moore Financial Strategies. To learn more about today's program or to talk with Susan, call 520-296-4464. That's 520-296-4464. And make sure to tune in again next week at this same time for Safe Money Strategies.
Protecting all you have.